Hello, ORAT Nation. Today is Easter Sunday. I hope everyone's doing well on this Sunday. It's a beautiful day here in Florida. I want to do in this session it's kind of a special edition. I'm going to call it part 3 of my Technical Analysis 101, but it's really about trader psychology, probably one of the most important components of trading. And it was the catalyst for this was someone that posted last week or the week before on the YouTube channel asking a question, which I thought was really good. And actually, Mike Zuber, who's with his family today on Easter, so it's just going to be me. But he forwarded it to me and said, this is a great question. Maybe you can address it. So I want to I'll show you the question and then we'll talk about it. Let me jump into it. Share my screen here. So this is my website. If you're interested in receiving the newsletter, you can just go to breakpointtrading.net, click on this button for the free newsletter, or at the bottom of the page, you can register your email if you want to be reminded that the newsletter is available. No charge. We don't ask for a credit card, and we don't share emails, so you should never get spam as a result of signing up here. Or if you want all of the content on the site, it's $99 for a year. So that's the website. So what I want to do is I'm going to start with, this is a presentation, and this is the question from a subscriber. How do you deal with buying? And the person that posted this in YouTube, I'm sure you'll recognize your post as well. Other people might as well. But the question is, how do you deal with buying into a stock initially and setting up your first stop? I worry about buying into a stock and getting my stop taken out immediately after buying. I want to hold stocks for the longer term, not interested in day trading. Be cool to see a video of how you research what stocks to buy and then how you set your initial stop, which I'm going to do at the end. But this part right here, I worry about buying into a stock and getting my stop taken out immediately. This is all part of trader psychology, and this is what I want to talk about first today, because this is a really important component. So let me start with a quote that I'm sure everyone's familiar with from Warren Buffett. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. So I'm sure everyone's heard this before and probably kind of know what he means by this, but this is what most people think, and rightly so. This is the view of basically trader emotions, market emotions, starting with optimism, enthusiasm, exhilaration as the market moves higher, which is, I think, about where we are right now, until we get to the peak, euphoria. Bull market ends, that's the highest risk. And that's what Buffett meant by when most people are greedy. That's when he's fearful. So he's not buying here. He probably doesn't sell because he holds things forever, but this is not where he's probably looking to add or buy something new. But most retail traders will start buying in this area here, enthusiasm, exhilaration, because they see the market has proven itself as going higher and they want to get on board. They have a fear of missing out, so they start buying at probably the worst time. And then the market rolls over and they get uneasy. Then they go through denial. Nah, it's going to come back. It's going to come back. And then pessimism. No, I don't know if it's going to come back. Panic. And then finally, they get ready to sell. Capitulation, they've had it. They don't ever want to deal with this market ever again. And finally, despair. And this is where most retail traders end up selling, right at the bottom, when they go through capitulation and despair. And this is what Buffett means by, while most people are fearful, that's when he wants to be buying. So that's when he's greedy. So this is when the bear market ends, and it's also the point of highest opportunity. And then the cycle starts all over again. But what if there's another way to interpret Buffett's quote and apply it to an individual trade instead of the overall market? So trader psychology, this comes from Investopedia. Basically, fear and greed are commonly associated with psychology, while things like hope and regret also play roles. Trading psychology is characterized primarily by the influence of both greed and fear. Greed drives decisions that might be too risky. Fear drives decisions that might avoid risk and generate little return. So that's a definition of trading psychology. Basically, it's fear and greed and hope and regret, and especially hope. So this comes from, the rest of the slides come from a book by the name of Best Loser Wins. And I highly recommend everyone that's interested in the stock market to read that book. And when you finish reading it, I suggest you go back and read it again. It's a really good book. It really talks about how we think and how important it is how you think when you're in the market. This one here was a conversation that the author had with a Wall Street trading company. Actually, I think it was in London because he's from the UK. And he was asking, what do you look for in a successful trader versus a normal trader? And he said, number one, account size. Anyone starting with less than 1,000 will likely lose their money. Trade frequency. Someone who trades everything and anything will eventually lose their money. And I know some people that trade or buy everything. They sometimes might have 50 or 60 positions at one time, hoping that some of those will really take off. But the problem is that that hope leads them to not get rid of the losers, and they hang on to them. So they buy everything and anything, will eventually lose their money. Amount of time spent holding winning versus losing trades. This is really important. Anyone who can't hold on to their winners, but does hold on to their losers, will eventually lose their money. Adding to winning trades versus adding to losing trades. Those who add to their winners will eventually be profitable. Those adding to their losers or averaging down, as many of you might have heard, will eventually lose their money. And then finally, and most importantly, trading without a stop loss. Anyone trading without a stop loss will eventually lose their money. So this is a study that was done. This is, again, is in the book, Best Loser Wins, study that was done over a 15-month period, 25,000 traders executing 43 million trades. The results were 61% of them ended in a profit. So 61% profitable trades versus 39% that ended in a loss. So 6-to-4 ratio, pretty good. Actually, in trading, that should be a profitable portfolio. However, when they looked into the details, they found of the 61% of winners, profit was 43 points. The 39% of the losers, the loss was 78 points, or essentially a net loss of $419 if you convert this to, assuming this is just 100 trades, $419. The reason for that is because they hang on to their losers, hoping that they will come back. And as this quote from Jesse De La Cruz, hope dies last. And that's what many people do. 90% of traders have a fear of having the gains from their winners taken away. So that's why they sell early. They don't hold on to their winners, and are also greedy by holding on to the losers with the hope they will turn into winners and not using stops. So winning traders are much more trusting of the prevailing trend. They're not emotionally attached to the idea of cheap or expensive. And this is an interesting comment because many times people think when the market is going higher, like right now, then that means it's expensive. And you might not want to get in, or you might want to sell and get out when it's expensive. That could be true, but it doesn't necessarily mean that the market can't go higher. Same thing with when stocks go down and people are waiting to identify a bottom or think they can find the bottom. They think stocks are cheap just because they're going down. But believe me, cheap stocks can get much cheaper. I've seen $3 stocks go to $1.50, that's losing half of your portfolio. So winning traders are unemotional about jumping on a trend. What separates the 10% from the 90% is how they think. Best way to the rational mind to resolve the discomfort of a profitable trade is to close it. Best way for the rational mind to resolve the discomfort of a losing trade is to keep it open with the hope it will become profitable. And that's what many people do, including those professional traders in the study that I just showed you. So retail traders in losing positions are very reluctant to realize the loss, so they just hang on to it forever and ever and ever, replacing fear with hope that it will eventually come back. We don't see things as they are, we see things as we are. So psychology is the most important thing. This is also from the book, Best Loser Wins. where it looks at the actions that people take and the conscious reason of the things that they tell themselves, why they're taking those actions. But essentially, most all of those actions, the subconscious reason is to avoid pain. They sell too early to avoid the pain of having the market take their gains away, and they hold on to losing trades too long to avoid the pain of realizing the loss when they sell. So this is what you have to overcome. 99% still don't get it. When they win, they start betting less. Bet more. That's from a professional trader on the Chicago board. So again, back to Warren Buffett. We simply attempt to be fearful when others are greedy and greedy when others are fearful. Think about it on the individual trades, not on the overall market. When you're in a winning trade, instead of thinking about where to get out, why not start thinking about where to get in more? That's from Dr. David Paul, who was ran the European division for VectorVest. Sadly, he passed away last year. He's an unbelievable trader. I sat in every week. I sat in on his sessions and learned a lot of it, really good information from him. I encourage you to go out on YouTube. He's got lots of videos out there if you want to learn about trading and learn about technical analysis and how to trade and how to think about it. I highly encourage it. He's really good. So being a good trader has very little to do with tools and charts. Now, who would have thought that that would be coming from me? Because all I do is talk about charts and technical analysis, right? But that's important. It's important to help you with entries and exits. But being a good trader has little to do with those. It has everything to do with fighting our humanness. Why do people bet less when they're winning and more when they're losing? Fear. Everything you want is on the other side of fear. So this is really important. Trader psychology is super important overall if you want to trade. It brings us back to the subscriber question, and I'll talk about now how I identify potential stocks to get into and how I set stops and how you should think about stops in the context of that psychology of trading. So let's let me go over now to we'll go to stock charts, and I'm going to show you a scan that I created. And actually, the scan is on the website for those that are annual members under chart lists and scans. It's called One Scan to Rule Them All. It's right here. You can just click on this and you can copy and paste the scan if you have stock charts, or if you even have the basic stock charts that only allows you to have one scan. This is a really great one because it has all of the other scans in it. So I actually have it right over here. One Scan to Rule Them All. I just updated it on Saturday. But what I do is every week I create the top 10 list from 3 different subscriptions that I have: Investors Business Daily, Earnings Beats with Tom Boley, and VectorVest. And I put the top 10 right here. I put the top 10 large, mid, and small cap stocks as well. And then what I've started to do is to consolidate all of these and start saving them every week, because I notice that a lot of times they drop out and then they come right back in. Maybe a couple of weeks or 3 weeks or 4 weeks later, they'll come back into the top 10. And what that means is they've made the top 10, but they might be at the top of their run. So they pull back for a little bit and then they come back again. So I wanted to see if I could find where those ones that were pulling back that were very strong stocks. So I started accumulating them all into one chart list every week, and I add more to it every week. That also includes the top 3 in each of the sectors. So all the sectors over here have a top 3 every week. If it has an asterisk, that means it was just added that week. So it's brand new. But these are also included in this list right here. So this is the list that I work with. That's the main list. I have others, but that's the main one that I work with. The first thing to do is to see what the sectors are doing. So up here, the top of the screen, I have a link to Sector Tracker. If you're not a subscriber, you can get Sector Tracker yourself. Just do a Google search for Sector Tracker and you can get this too. What I like to do is start with 1 month ago, and I want to see which sectors are the ones that are outperforming. And we can see a month ago, energy was doing really well. Energy, materials, Utilities, interestingly, which is one of the most conservative, the highest defense-related sector, is doing well also. But energy right here 1 month ago looked like it was doing great. Financials too is looking pretty good, and industrials. So let's go 1 week out. Energy's still doing great. Utilities is doing even better. Healthcare now is starting to come back. So healthcare and energy look like two interesting sectors. If we go just for 1 day, so this is as of the market close on Thursday, energy again is outperforming all of the rest. Real estate, also a very conservative sector, starting to come back as well. So energy might be one that I want to look at. So what I do is I come over to my one scan to rule them all. Excuse me. And in the scan, so this is what I have that you can copy and paste. And if you have if you have stock charts, you can copy it right into your stock charts. I have a number of different chart lists that I use right here. Here's my Dow Industries, if I want to see which industries are doing well. These are unique to me. So these are not the ones that you should use in your own scan. You would have to replace these with ones that you are using. If you're a member of the site, you can actually just download. Like I said, I accumulate all of these top 10 stocks over time, and I put them in this list right here. This is a CSV file, which you can download into any other platform that you want, including stock charts. So each week this will get updated, and you can download it directly into stock charts. So whatever name you call it, when you download it, I call mine top 10 combined list. You just load it in there. Now these slashes in the beginning basically tell this script to ignore that particular line. And as you can tell, my whole thing has slashes in front of it. So it's essentially ignoring everything that's in this scan, except for a country is US. And you can change that too. So, and there's a little definitions on top of each one. So it explains to you, remove the slashes in front, etc. So I'm going to remove the slashes on this one. That's the chart list I want to use, the top 10 combined list. Then I want to go down to my strategies, and I want to find a strategy to bring those particular stocks in and sort them or search on them in a certain way. So we'll take a look at relative outperformers. Relative outperformers are essentially all the stocks in that list that are outperforming their own industry group and the S&P over a 65-day period. So both the industry group and the S&P by 7% or more. So those not only are they the top 10, but they should also be the best of the top 10, the ones that are outperforming both the S&P and their industry group. So when I run scan, it's going to give me a list that satisfies those particular criteria. And here's the list. So now I can see there's quite a few of them in here. And I can sort this by sector. So if I sort by sector, I can see there's some of the internet stocks right there. Williams and Sonoma just started hitting the top 10 list. You might recognize some of these names, but I want to look for energy. So here's the energy stocks down here. So everything that appeared, these are outperforming the S&P and their own industry group, outperforming their peers. So you can select any of these to look at it, but I'm going to take a look at Vista Oil. And the only reason I'm picking that, a couple of reasons. Number one, it's $41, so it's not real expensive. Some of these are, $200, $400, $500 down here for this one. That one's reasonable, 41 bucks. So I'm going to pick that one. The other reason that I'm choosing it is because I've been doing that list, the top 10 list for so long, I become accustomed to ones that keep appearing over and over in that list. And I recognize this particular one, so it probably is going to have a nice chart. So I right click on that and I open it. And when I open it, sure enough, that's a nice looking chart. It's just moving from lower left to upper right. It seems to be bouncing off of its moving average lines. And it happens to be pulling back right now. So this might be a good time to start looking at it. Doesn't mean it's the right time to buy it yet. But remember, this was in the top 10. It's outperforming its industry group and its peers, which when I look at it in a little closer view right here, I can see that down below. So this gray one is the S&P. So this is Vistra Energy outperforming the S&P. And the blue one is its own peers. And it's in the exploration and production group. It's outperforming its own peers as well. So it's above its 50-day moving average. So that's good. That's what I wanted. It's pulling back, by the way, on low volume. That's another good sign. So I like that. The 21-day moving average is at 40 right down here. So that might be a place where I might want to buy it. So I can put an order in to buy. So I'll put a limit order in to buy it at $40. But the question is, where do I put my stop? Now, the main question that was asked was, how I have a fear of placing a stop and being immediately taken out. So first off, about stops, you should always have a stop, but when you put the stop on, you should mentally, psychologically be training your mind to accept that it will get taken out, that the stock will go down to that stop level and it will sell and you will take a loss. You should be mentally preparing yourself that that's going to happen. So the second thing is you don't want to put your stops too close because then it definitely will get taken out too soon. And you want to put it somewhere that makes sense technically. If you go back and look at Technical Analysis 101 Part 1 and Part 2, especially Part 1, will kind of show you that. So one thing I can do with this is I can put in a horizontal line right about here, which is a support area, or it was resistance. You see where it came up and got rejected here a couple of times and then finally broke through. So that's a support line. That's right at $38. So that right there looks like a pretty good place to put a stop. You can see that this is normally has come down to the 21-day many times and gone back up. And it may come back to the 21 again. In fact, if it does, that's where we're going to buy it at 40. And we're going to put a stop at 38. So if it continues to go down, we buy it at 40, we're out at $38. So keep those in mind. Also the thing to look at is the ATR, and I put it on this chart, and you can put it on your own charts as well. There's other ways that you can find the ATR. ATR is the average true range. So average true range is essentially the average that this will move in one period. The period we're looking at is daily. So in one day, over the last 13 days, this has moved $1.39 over the last 13 days. So that's the average range that it moves in. So $1.39, if we buy it at 40 and we put our stop at 38, $1.39 should be a pretty good place for it, right? Because 38 is $2 below the 40. So the next step is, how many shares do we buy? How do we make sure to keep our risk low and even be more comfortable with where that stop is? So that's where I use my risk calculator. And the way this works is I just type in the symbol name right there. I click on this button and it shows me a chart, and it will tell me what the ATR is right down here, ATR 138. So now I know what the ATR is. I can see the 38. You can see right here, you can actually move this to 38 where I showed you before. That looks like a pretty good support area right down there. We could also move it even further down if we want to be more conservative and put it down at 35.50. But that's pretty far. So I'm going to try 38. 38 and $1.38 is the ATR. So I need to put the ATR in here, $1.38, the average true range. Now what this does is it will calculate double the average true range to help you with setting a stop. We'll see what that is. We said we're going to buy it for $40. So it's at 42 right now, roughly. So we're going to set a limit order, and then we can just leave it and forget about it to buy it at $40. If it gets down there, great, then we're in. But the stop that we want to set, I said, was 38. Now, if you use 2 times the average true range, it actually calculates that for you right here. It says it's 37.24. So you could use that, 37.24, 24. And it will tell you the percentage loss that you would take is almost 7%. Interestingly, on the left-hand side, on the yellow side, you put in a percentage over here. If I put in 7%, which is what Investors Business Daily usually recommends, look at that, it's almost exactly the same. So the 7% level that recommended by Investors Business Daily is roughly 2 times the ATR. All right. However, I said 38, so I'm going to make mine a little bit more aggressive. But what this does, and we need to put an account value in up here. So I'm going to try, let's say, $20,000 account value. And whatever your account value is, you can put it there. You can do this for 3 different accounts if you want to. You can do it for 3 different stocks in the same account if you want to. And what I do is if I use it for 3 different stocks, when I save it, I'll just say save as, and I'll put the symbols that I'm put in there. So when I bring it up the next time, and I can actually see where I started. So now it tells me how many shares I can buy. 70 shares in either case. I can buy 70 shares. Now what this does is it takes the trade rule, which is 1%, never risk more than 1% on any one trade. That means based on your price and your stop. So 37.24, I'm going to change this to 38 because that's what I was using. 38 over here. So now I can buy 100 shares, by the way, because I moved my stop up because I'm not going to lose as much. I'm only losing 5% if it does hit that. But now I can buy more shares. So what this does is it looks at the difference between my stop price and my buy price and compares it to 1% of my portfolio, which is in this case is $200. And it shows you how many shares you can buy. It's 100 with this stop, 71 with this stop. The second one is the account rule. Oh, I've got 100%. I don't want that. I want 10%. All right, now it's dropped these to 50. That's better. So what this means is if that company goes out of business tomorrow and the stock is worthless, I don't want to lose any more than 10% of my whole portfolio. What that also means is you can only have 10 stocks. So it limits the number of stocks you can buy. If you want more stocks, then you can lower that. If I want 20 stocks, I can lower that to 5%. But now you can see I can only buy 20 shares, right? Or if I want to be more aggressive and buy more, I can raise that to 20%, which means I can only have 5 stocks at any one time. Now I can buy 100 shares. But I'm going to leave it at 10 for now. The third one is the volatility rule, which incorporates the ATR, the average true range, because that helps you understand volatility. If you had 2 stocks that were at $40, they would move on a daily basis a different range, a different average true range. One might move only 50 cents, which is less volatile than one like this that moves $1.38. Or one might move $2, which is more volatile. So this takes into account volatility. And what the calculator does is it calculates the amounts for each one of these. So you can see up here, trade rule says I can buy 100. My account rule says I can only buy 50. The volatility rule doesn't show how many, but it will calculate based on each of these 3, whichever one is the most conservative of the 3. So I don't have to think about it. I don't have to do anything other than just plug in 4 numbers. All right, so now I'm down here, $38. I know now I can buy 50 shares. So that's what I'm going to buy. There are other things in the calculator that can help you, do scaled in entries and things like that, and helps you understand where your targets might be. I don't necessarily recommend using a target because you don't want to sell too early if it's going up. If the stock is going up, just let it go. But if you do want just kind of a guideline of where the target should be, that helps you there too. But right now, what it's telling me is I can buy 50 shares. If I lowered this stop down to 36, like we saw before, okay, I can still buy 50 shares. So I'm going to lose a little more. I'm losing 10% now instead of 5%, but I can still buy 50 shares. So we'll leave it at 38. I can buy 50 shares of this particular stock. All right, so now I know how many shares I can buy. So now if I go back over here and we're going to buy it right here, make this green. We'll buy it at here at $40. And we will put a stop right down here at 38. Now, remember what I said about stops, because the question was, I have a fear of my stop being taken out. Once you set your stop, you never lower it. So you want to set it appropriately based on your risk level the first time. If you are a long-term trader, as this person said they were, you might want to even be a little more conservative. Maybe move it down to 36. You can still buy 50 shares, but you're going to lose 10% if it goes all the way down there. Regardless of where you set it, mentally assume that it's going to be taken out and you will lose that amount of money. That way, when it happens, you won't be surprised, you won't be emotional, you'll just move on to the next one. Now, what happens once I'm in the stock? So in this case, I'm going to actually use an example from somebody that was at the Las Vegas event. And this is using Best Buy. And this person said to me, you know, I'm losing sleep at night because I work for this company and I got a lot of shares on the employee plan, and I'm not there anymore. But you know, I'm really concerned if it goes down, then I'm going to lose money. And it went down once before and came back, so I can't sleep at night because of that. And I said, well, just put a stop on it. And he goes, well, I don't really know how to do that. So I said, well, let's take a look at it. Now remember, the Las Vegas event was right here around the middle of February, right around where this red and white candle are. So I looked at the stock with him and I said, well, let's put a stop, you know, as soon as you go back after the weekend. And by the way, I don't know if he did this or not, so I have no idea. But let's, what I said was, let's look at the lowest level it was at right down here. It's about $69. So we can put a stop right there. And right now we are right here. So it looks like it might be starting to go back up, but we don't know. We don't know if it's going to come down. But once you put the stop on it, then just forget about it. You can sleep at night. You don't have to worry. If it goes down to 69, you're out. You know, at that point it was at 72. So he would be very happy with, you know, $3 loss, but mentally he was prepared for that to happen and he would be out of the stock. And I said, and if it doesn't, then if it starts to go back up again, then just move your stop up. The way to do that is to watch for a higher low. If you see higher lows on the chart, and you can use charts just for this alone and nothing else. Very simple to do. If it's giving you higher lows, that means it is in an uptrend. So if it continues higher, you can see it hit a low right there. That's a little below 72. So it started to move up right there. So great, move your stop from 69 to 72. That's almost where it was when we were talking. And then it went up and it came back down, and then it started to go back up again. So there's another higher low. So now move it up here. So now it's at 74. Now it's above where we were talking. So now watch it again. So it came down a little bit, hit here, and started going back up. So move the stop up again. Now we're at a little more than 75. It's about, yeah, a little more than 75 right there. And that's the way to use stops. Be mentally prepared that it will get taken out, but if it doesn't, and you're correct about the direction and it starts to move up, then continue to move your stop up with it so that you don't give away all of your profits. But don't put it too close either, because you don't want to be taken out too soon. So right now this is at $82 and we're at about $76. So that's about 9%. So remember, we started off, well, I don't know what we started for this one, but it's about 9% loss if it comes down there. So that's the way you can move the stops up. You could use the 21-day too, move it up just below the 21 if you wanted to. That's a little bit more aggressive. So if you're a long-term trader, you might want to, you know, be a little more conservative and let it run. But you also don't want it to start making lower lows, because lower lows means it's in a downtrend. So you want to take your profits before that happens. Anyway, I hope that was helpful in understanding how to play stops and how to mentally prepare yourself for that. Remember, don't sell too early. Let stocks run. Be mentally prepared. The human nature is, the stock runs up. I mean, let's look at NVIDIA, great example. The stock runs up and gets way up here. In fact, if we look at it on a 2-year basis, that looks even scarier. So the stock gets way up here, and you're like, wow, I don't know. I've had it for a while, and I've got huge profits on it. I don't want to give up all those profits. So that right there is fear or avoidance of pain. You want to avoid the pain of giving back your profits. You have to work through that. That's the humanness that's in all of us. You have to have good reasons to get out. And just by looking at the chart, it keeps following this pink line up. So if it's not going below that, then why get out? Just stay in it. Now, one question that came up a while ago was, what am I going to do? Because I have NVIDIA. And what I did was I looked at the charts and I placed my stop right here where this open gap is, where that gapped up. That's at $825. So I put my stop right there, and I am mentally prepared for that to happen, for that to come down. And what a lot of times will happen, not a lot of times, but often will happen, is it'll come down right to that level or just below that level, take your stop out, and then continue to go higher. And now you're not in it. And that's the other side of human nature. We want to avoid pain, and sometimes it's actually more painful to see a stock take off without you than it is to take a loss. And that's one reason why people just go into a loss and stay there. They don't sell the stock. But I am mentally prepared for that to be taken out at 825. Now, if it does, and I can see good reasons to get back in, I'll get back in, and I'll get back in higher. I'll get back in at 850 or 875 or whatever it is. But don't get locked into thinking about something as too cheap or too expensive. Just do things without emotion that makes sense based on what the movement looks like. So that's what I'm doing. And what I've said before is that I think NVIDIA might move sideways. So if we look at the chart, this one here, it's moving sideways right now. So it's probably going to move sideways in a channel before earnings. And usually about a month or so before earnings are on May 22nd. A month or so before earnings, just like it did right here, it will start to run higher before the earnings. And just before earnings, people will take their profits because they don't know what the earnings are going to be. And then when it comes out positive, it takes off again. So that's what I think is going to happen. It's going to go sideways in this channel. It'll start moving up into earnings, and then we'll see what happens. But that's the way I use stops. That's the way I set them. There are lots of different ways to set stops, but the most important thing is the mental aspect of it. Just like I pointed out here, I worry about buying into a stock and getting my stop taken out immediately after buying. And you have to be prepared that that might happen. So hopefully that was helpful. I'm going to post this as Technical Analysis 101 Part 3, because the psychology of trading is probably the most important thing, even more important than the analysis part, the technical part. And in my book section, I have a whole section here for psychology of trading. And Best Loser Wins is located right there. So these are all really good books. So I recommend that you read these as well. Okay, that's it. Hope everyone enjoyed that session, and I will talk to you later. Have a very happy Easter. Take care.